Today I'm going to start with Cathie Wood and some others, thought leaders, on the direction of the market and the direction of the economy. In other words, here we are nearing the end of 2023. As we look into 2024, is it an optimistic view? Are things going up or are things not going up? Maybe they're going down. And I thought I would begin with Cathie Wood, and that's why I put her picture on this video. And then I'm going to play her and some others so that you can see from a thought leader's perspective what they believe is the direction of the market. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is November 21, 2023. Cathie Wood is the CEO of ARK Invest Funds. They are innovation funds in about, I believe there are 5 of them in different segments of the economy, all in the innovation space. And when you say innovation, the number one name that people think of is Cathie Wood. Her funds have done very, very well, and then they crashed in 2022 very badly. And but now they're recovering, and so, but they are early stage companies, and they're public, and they're part of her ETFs in the innovation space. So she makes the case, and I'll play this clip from her. She makes the case that when she's been saying this, by the way, since early in 2022, so maybe a year and a half or so. She's been saying that we're talking about inflation, and Cathie Wood kept saying, but we're headed eventually into deflation. She kept saying deflation when everybody else was saying inflation. It kind of seemed to make no sense, but now it's starting to make sense. And she's not putting necessarily a time frame on it, although I think she implies maybe into 2024, but that the Federal Reserve has applied aggressive rate hikes to counter inflation. There have been so many rate hikes over such a short period of time that she believes that that's going to put the brakes on the economy, and I won't say crash it, but bring it down, slow it down, run it into negative growth. Negative growth means contraction. Run it into a contraction period. If we have contraction for 2 quarters in a row, that's called recession. And so that's the case that she's making, and she states why that's the case. Following Cathie Wood, I'm going to play a couple of other pieces from Dr. Lacey Hunt and Joe Terranova, all of which sort of make the same case, but from very different perspectives. So listen to this piece from Cathie Wood.
Obviously, CPI, you saw it cool across the board in October, both on headline and on core. And to say the least, the market reaction has been pretty swift. Curious to hear your thoughts, though. When you think about what this means for the Fed, is it safe to say that we've seen the last Fed rate hike of this cycle?
First of all, I'll say I agree with almost everything Ken Griffin just said, except his comments about the Fed. For some time now, we've been saying that the Fed has overdone it and that the greater risk here is deflation. Yes, the CPI did not surprise us at all, although there were rumors that revisions would take it higher than many people thought. And so we believe we're beginning to see deflationary trends in many more sectors now. It started with commodities. Now we're seeing airline prices coming down, auto prices coming down, and we're seeing staples prices. They have been sticky, but what's happened to staples volumes? They have gone down. That's not how you run manufacturing plants. So we think that they will be forced into cutting prices as well. You heard Home Depot today, negative 3.8% comp store sales here in the United States. And if you look at the S&P 500, I think a third of all companies in the S&P 500 are reporting negative revenue growth. What we have characterized the last 2 years as a rolling recession. Some measures of housing are down 40%. That's a recession. Autos, 15 million units in the U.S., that's kind of punk. It's recession-like. And we're seeing these volume declines in staples.
Right.
You've got consumers pulling back. So I think the Fed's overdone it. I think we're going to see a lot more deflation going forward. We are going to hit that 2 handle, and we will go below it, and would not be surprised to see CPI inflation negative at some point next year.
So to play off of what Cathie Wood said, I want to play a piece from Dr. Lacy Hunt. He's an economist. He represents a very large fund and has been around for a long time, very respected in the investment industry as a thought leader and insightful. So he brings a wealth of experience over a long period of time. And he says very quickly when he's answering this question from Bloomberg, he says very quickly, the U.S. is headed into a hard landing. And the word hard landing, you probably know it, but if you don't, what that means is sort of the economy is going to crash. It's not going to be pretty. That's what hard landing means. And as opposed to soft landing, which means we'll get inflation down to 2% and nobody will really pay much of a price for that. And a lot of people want to believe that. That term soft landing is still out there a lot. But he says, no, it's going to be a hard landing, and he explains why. He takes, and this is his view, is he takes a macro view over the next few years. And I think at one place he even says the next couple of years. So don't read this as the next few months or the next quarter or early in 2024. I think he's giving himself some space here to say, let's look out over the next couple of years, and sometime during this period of time, we're going to have a hard landing. And this means to me that we will end, or that period will be a recessionary period for some period of time. We don't know how long. And when you're in a period of hard landing, or as Cathie Wood said, in deflation, what that means is prices are coming down. Whether it's commodity prices or actually stock prices or bond prices. So I believe, as I infer into what Dr. Hunt talks about, is I think he's talking about also, he doesn't say stocks and bonds, but when you talk about hard landing or deflation, I think you're clearly talking about asset prices, including stocks and bonds, coming down for some period of time. Is that 30% or more? That would be a lot. I don't know. But it could be 15 to 25%. I don't know. But there's some kind of contraction in prices ahead, according to what Dr. Hunt talks about. So from a different perspective, listen to Dr. Lacy Hunt.
I just look at the most recent data, the jobs data, the services data, the equity market ignored the bad news and went with a soft landing scenario. The bond market saw the data as an end of the Fed tightening and a break in the clouds for the bond bulls. Would you agree that there is a break in the cloud for the bond bulls?
I would say the cloud is breaking because the economy is heading into a hard landing. But it's a process that will take time. The U.S. economy has very serious difficulties. Difficulties are going to be with us for a long time in the future.
That hard landing, when we last caught up with you, if I look at M2, and I know that you're an advocate of ODL, other deposits and liabilities, but M2, according to the St. Louis Fed, is negative for the first time in nearly 70 years. Is that going to cause a much harder landing, perhaps, than the market presumes right now when you look at bond yields at 4.5%?
Well, several years ago, I rewrote Friedman's great paper to the American Economic review on theory of interest rates. And Friedman said monetary decelerations lead to lower interest rates. I adjusted his theory to say that monetary decelerations lead to lower interest rates unless the velocity of money rises. We have a very serious monetary contraction in real dollars, which is the way I prefer to look at it. If you look at my preferred measure, ODL, or it has declined in real terms over the last 12, 24, and 36-month intervals. And although velocity has risen slightly over the last 2 years, I believe the velocity is in the process of making a move to the lower side over the course of the next year. And this will greatly complicate the Fed's ability for monetary policy to work when they do decide to lower interest rates. There's an old phrase that when the Fed tries to stimulate there, it's like pushing on a string. In this particular case, the pushing on the string will be even more difficult than normal for the Fed. The Fed's capabilities will be very asymmetric when they need the economy's support, which I suspect they are going to need quite significantly in the next couple of years.
A frequent speaker or host on, not a host, but a guest panelist on CNBC is Joe Terranova. He's very accomplished and has done a lot in his lifetime, and they're fortunate to have him on there frequently as a panelist. He talks about, and this makes a lot of sense to me actually. We've been in this period of time just for the last few weeks where the market has been going up and up and up after being declining for a period of about 3 months. He talks about the market going up from here and then in 2024 going into a period of decline. That makes a lot of sense to me personally. I don't do predictions. I try to stay away from that. But as he does that sort of a prediction, it seems to fit with what Dr. Hunt and Cathie Wood were talking about, as well as the current environment that is a positive environment where equities are going up. And actually, bonds are going up. So take a listen. I think it adds to the comments from Cathie Wood and Dr. Hunt appropriately. So take a listen.
So we've had this, going for this streak, 3 in a row. Where do you think we really are now? We got, 6 weeks. 6 weeks or so between now and the end of the year. What are we primed to do, if anything, based on what we just did?
You left the Russell out. The Russell, I think, is the Russell is so critical.
I gotcha.
So the Russell's up 1% today, and I think that provides overall stability. I think markets are in a consolidation range right now. I think they're consolidating a very strong run. You have significant options expiration this afternoon, but I don't know. It's a very quiet market today, and generally, history will tell me you don't sell a quiet market. I still think there's more room to the upside. I said that with you yesterday on Closing Bell. Turn the calendar into 2024. Okay, I understand things get more difficult when you're looking at what's the economy going to do, and I think it's going to be decelerating. But this chase for performance, even if we've had the majority of gains so far, I still think the bias, the inclination is to go in and to be a buyer. And it looks like the last stage of this chase for performance is really being led by the Russell catching up to the NASDAQ and the S&P, and that's what's happening today.
All right.
Next, I want to show you a few charts. These also play into these past 3 clips that I showed you. So they sort of make the same case. Now, the first one I want to show is this one, which shows that this is where they use an implied rate. In other words, this is where the futures are and what investors are saying what they believe is probably going to happen. And you can see from the chances of, from an investor perspective, the chances of a reducing interest rates or increasing interest rates or no change in interest rates. So up at the top, there is a line, that's the 0 line, and everything below that shows that the amount of rate decreases from the Federal Reserve that are expected in 2024. And at the end of that, which is the current period, it shows a decrease of 1% on interest rates. What that means is that there are expected to be 4 25 basis point decreases, excuse me, 25 basis point decreases over the next year. That's a lot. What we've been having is a lot of increases, and now all of a sudden it looks like we're going to have 4, according to where the investor sentiment is. So what that tells me is that the market is going to come down, and they're going to try to elevate the market. They're trying to stimulate the market, and they do that through rate decreases. So this also is telling you the story. If you read through the, I guess, read the tea leaves on this, what it's really saying is that, yeah, we're probably going to have a very difficult economy in 2024, and maybe, therefore, a difficult stock market. This is a retail sales data month over month, and you can see that retail sales have been going up, generally speaking, and now this last period, this last month, they have started to come down. Again, playing into the narrative that we're probably headed into more challenging economic times. This is a survey that's done by the NFIB, National Federation of Independent Business, which is basically small businesses, and what is their optimism on sales going forward. So this is a minus 17. A minus 17 on this chart shows a very negative view from the view of small business. Again, tying back into the videos that I just showed you. Okay, Ms. Yellen, Janet Yellen, our Secretary of the Treasury. If you ever listened to her, you probably could surmise that this quote is probably similar to the way she would say things. In conclusion, I'm either completely clueless about what's going on or deliberately lying to you. Okay, I don't know which. And I try to stay away from politics, so I don't want this to be political, but I would say from a monetary policy standpoint, she definitely seems to try to ride the fence a lot. Thank you for watching. If you have questions or comments, leave them in the comment section below. Thank you.